Good morning, James.
Brilliant, all working, that's good. As we go, people, if you want to ask questions, please just stick them into the Q&A function or just email me at jc@martinco.com. As I say, we've had you on the show before, so we won't dwell too much on how the mechanics of the fund works, but do you want to sort of give a brief introduction for those of you that maybe didn't see it last time, please?
Yes, of course, and thanks very much for having me on the show. So Oakley Capital Investments, will typically refer to it as OCI, is the investment company that was established and listed in 2007, was listed on AIM, now listed on the main list on the specialist fund segment. And it provides investors exposure to a focused portfolio. It's about 21 companies in there currently of high growth private companies. And these are established, profitable businesses. And if you look at the last 12 months, they on average grew their earnings at 35%, to give you a sense of the kind of quality of the company's growth. How does OCI achieve this? Well, it invests solely in the funds managed by Oakley Capital. So it's a listed direct private equity vehicle, in contrast to fund of funds. And I guess the closest peers in type and performance are the likes of an HGT or an Apax Global or even maybe a 3i. Oakley Capital, as I say, is the manager. And they advise the funds that OCI commits to. So what does Oakley Capital specialize? It is European, pan-European in focus, and they're private companies operating in three main sectors: technology, consumer, and education. I guess there is an overarching theme, and that is a large number of the portfolio, 70+% of the portfolio delivers their products or services digitally. So there is a kind of a tech-enabled kind of umbrella theme across all those. For further clarity, obviously there are many shades of private equity, from kind of early stage venture all the way up to large cap global PE. In this case, we're talking about mid cap buyout private equity. So we're taking controlling stakes in established medium-sized companies. You've got there on the screen, James, a little bit about our investment strategy. Shall I touch on that and what differentiates us?
Yeah, please.
I guess the key why James particularly put this slide up is that if we were allowed to kind of identify one thing that we think separates us from other PE firms, it's how we originate. And obviously that is a particular hot topic now, when, as we may go on to discuss, the increasing amounts of funds drawn to private equity. And the biggest source of differentiation is our network of business founders. The private equity manager was founded by an entrepreneur, and he didn't realize it'd happen on a particularly kind of differentiated strategy, but he essentially wanted to set up a financial partner for other entrepreneurs. He felt that the industry really wasn't set up to understand, support, and work alongside business founders. And in having that approach, we now, going on 15, 20 years, have a network of business founders. We've backed over 20 odd now, and some of them repeatedly, some of them we're backing for the kind of third or fourth time. To demonstrate the quality of the relationship we have with them, many of them then go on to invest in the funds, which is a great kind of endorsement of their relationship with us and how they think of us. So about 170 million euros of our assets under management have actually been committed by the entrepreneurs that we've backed. What does that mean in terms of our deals? The stat up on the screen is that 75% of those since inception have been uncontested. So what do we mean by that? It's not come via an auction or a heavily intermediated process. We are essentially sourcing something on a proprietary basis without competition. The other key stat is that 88% of all our deals since inception, because of the way we approach sourcing, we have been the primary capital, the first private equity firm to back those companies, which gives you a sense of the ownership prior to us, and that we're not reliant upon the existing pool of companies that have been backed by private equity. We're bringing more companies into the space. The other stat worth mentioning is that 40% of the deals we do are carve-outs, so extracting a business from a larger parent. What's the so what of all that is, if you are doing deals where they're not being prepared professionally for sale, the founder has, the family run businesses for quite a number of years potentially. The fact they've never had private equity capital is that you are no doubt navigating some form of complexity by virtue of the way we're doing these deals. With complexity comes risk. If you can navigate that complexity, and we feel we're entirely set up to do so, and that is our intention, to kind of be able to cope with that complexity, and there's a number of ways we can, then you get to invest in these companies at advantageous valuations, at valuations below the average market. So to give you, I mean, there's any number, the average multiple that we've paid for a company since inception is 9.4 times EV/EBITDA.
Right. Okay.
And that compares to their average growth today, as I mentioned earlier, about 35%. Just picking up the other points on the screen, active management is obviously key to value creation, and there's lots of ways that we look to create value for the companies once we have the ownership, and some of these will be, not necessarily distinct to Oakley Capital, but it is around bringing on other kind of senior management around the kind of founder, or introducing a senior C-suite to a business if we're acquiring something that doesn't have a founder or the leader of the business in place. Digital acceleration is key to us, and that is a big theme across all the portfolio. Improving the quality of earnings, so maybe taking them more to a recurring subscription-based revenue. Marketing excellence, but as we highlight on the screen here, kind of transformative M&A, buy and build, it is key to us. We've done 40 deals since our inception. Our first fund launched in 2007, but we've done 100 bolt-on deals onto those, essentially those 40. So to give you a sense, it's really key to our kind of value creation. Typical investment themes. I mean, I've mentioned here some of the significant global trends that we're investing behind. I mean, the most notable which is the growth of global internet users and the accelerating adoption of consumer and business digital solutions. So we're looking to kind of get exposure to kind of D2C and that digitalization, SaaS solutions, and often looking to repeat regional plays. So investing behind the digital disruption curve. UK, for example, incredibly mature market for price comparison websites and property portals. But Germany was 3-4 years behind the UK. Southern Europe, we're investing now, is a number of years behind Germany. To give you an example, car insurance, 70% of all car insurance is now arranged or executed online in the UK. In Italy, where we own the #1 price comparison website, Facile, when we purchased the company and before COVID, only 12% of car insurance was arranged online. We're not making a big cyclical bet on Italy. We're making a bet of internet penetration and the adoption of a digital solution.
Yeah. Okay, cool. Let's have a look. So these are the sort of trends of what's going on in the market. I mean, one of the things that's often talked about at the moment is the sheer amount of money that's being raised by private equity.
Yeah.
Do you see that as a problem or not?
Well, I guess the first thing to pick out from the slide is that you'll see that kind of 2021, there's obviously been a significant amount of fundraising activity in the first 6-7 months of the year. And if that rate of progress was continued, then yes, you would be looking at a record fundraising year. What's probably more notable is that it's being, as the kind of orange line denotes, the fund counts actually dropped quite significantly, indicating that there's a lot of capital being sucked into much larger funds. So the way I view the market, while it is growing and clearly returns are going to attract more funds, the bigger funds, the big global funds, are where a lot of the assets are being targeted, and they naturally are targeting, particularly large assets. I can't comment on their ability to continue to deploy at that level. They have proven to. So history and the current trend would suggest they are able to. I can only talk to Oakley's experience, and whilst there absolutely is more competition for the kind of companies that we invest in, and there's certainly been a lot more demand, or at least we've had a lot more approaches for our existing portfolios, you could imagine, and tech and education and consumer digital are as hot as they've always been. but we are still able to continue to source deals by virtue of how we go about sourcing them, as I previously described.
Mm-hmm.
We look here at I guess, to the point of, okay, so there's a lot of dry powder, there's a lot of funds being raised, but is it still being deployed based upon what we can see from investment activity? And here we see that we only had the stats going up to the end of last year, but even in a COVID year where Q2 was a very barren period for deals, it's only really dropped to the level that was achieved the year before that, so 2018. And signs are that activity levels are now back and beyond where they were in 2019. So the funds are being deployed. I've seen that on average, they quote a time to deploy dry powder within PE, and it's roughly around about 3 years, and that number has remained reasonably static. So the broader market is still managing to deploy the amount of funds going into it, and it still is, although it's talked about because of the rate of growth of funds going to PE. It's still a relatively small asset class. It doesn't compare, for example, to global listed public equity. So whilst growing, it's not oversized by any stretch of the imagination.
So I mean, so the vast majority of companies are private, but they're not
private equity
targeted by private equity. Yeah, exactly.
Absolutely. I mean, the stat, to give you some sense, in the US is like there's something like 14,000 companies listed and 18,000 companies formally backed by private equity. And as you rightly point out, there are way more private companies in the US than 18,000, but that gives you a sense of the pool.
Yeah. Cool. I've got some numbers here on how you've been doing on the NAV. So I think we should probably highlight those just to, because it's pretty impressive stuff. What's been driving returns recently? Is it market moves or is it the deals that you've been doing?
It's the earnings growth of the underlying portfolio companies. So I mentioned that number 35%. If you took the total growth in portfolio value over the last 12 months, so NAV over the last 12 months grew 26% to June. If you took the portfolio growth in that period, 75% of that growth was based upon EBITDA growth, i.e. you keep the same multiple, the EBITDA has grown, so you keep the same multiple of earnings. EBITDA has grown, and that's the valuation growing. The 25%, the other 25% is some multiple expansion, but it's relatively modest. I think we take the view that you definitively know with a private company the valuation of a business when you buy it and when you sell it. And in between is speculative. You can try and peg it to public market comparisons. You can look for when deals are exited within the private market to use as your comparables. But ultimately, there's a lot of flex. It depends on how your business is personally going to be viewed. It could be down to the quality of your EBITDA versus another similar companies. And also, I think one of the features of one of the attractions of PE is that you're getting access to companies which don't necessarily have direct or obvious public market peers. So, there is a really inexact science, I think, in the kind of valuing of private companies. And so to that point, you tend to find is that the companies within the portfolio will be pegged at a reasonably similar multiple to the one we paid at entry. And whilst there is going to be naturally some increase as you build something of scale, as the earnings growth kind of increases, or as we improve the quality of the earnings, we're absolutely going to see some increase in the EV/EBITDA multiple. For note, current EV/EBITDA multiple average of the portfolio is about 12.3 times EV/EBITDA. So relatively modest compared to the growth. But the big, the kind of clarity around the true value of the company comes at exit. And as a result, since inception, we've achieved a 44% premium on average whenever we sell to the book value, whenever we sell an asset. And actually in 2019, it was like nearly double that. It was 88, 89% premium. So there's a lot of value not reflected in that NAV, but it's definitely EBITDA that grows the NAV year to year. That's one of the things I think worth pointing out, is that maybe unlike the public market funds, there's no incentive for a private equity manager on their, kind of current book values. They are not paid in any way based upon the existing book value. Their reward comes from the performance fees, and that only comes after exit.
Yeah, exactly. It's one of the things that we've been banging on about, actually, is this hidden discount, if you like, within the NAV. So and that's sort of 40+%. That's over a number of years that you've been achieving that.
Since 2007. So that is since inception. Yeah.
Yeah. And so what sort of things make up that? Is it you're deliberately sort of marking things down for liquidity reasons, or?
No, I don't think. I mean, we're often referred to as having a very conservative NAV, but we follow what are called the IPEV guidelines. Our strong view is that the EBITDA is something that we, is an accounting measure. We can be exact around that. The multiple, whilst it may increase, for the reasons I've described, there's less clarity around that. And whilst it will increase, we'll never take a view that we'll necessarily get maybe the exit multiples that are currently achieved in the market until we go to exit. And that's exactly why, now, in most cases, not as an OCI situation, and it does happen in other funds, why shares should trade at or above NAV for that very reason.
Yeah. Okay. One of the questions we've got up here is, do you make more money on the bolt-on deals or on the original deals?
There's no exact science on that, because you collectively, often you're creating something of scale. You will naturally pay more for something the bigger it is. And I'm just thinking of certain roll-ups that we've done maybe in the software space. And so it depends on, the bigger deal could have been the last deal you did or the first deal you did. It depends how fractured the market is and the scarcity of assets. But you tend to find that what you make, your bigger return comes at the collective ownership of those assets, and then your ability to sell them at a higher valuation later down the line. So I don't think it's the timing of the particular deal, although clearly if you've started a roll-up in Southern Europe and now everyone wants a software business in that space, the last company you buy might be the most expensive company you buy. Or if it was the smallest company you buy, it could be the cheapest company you buy. So that is not a particularly exact answer, but there isn't one, I don't think, to the question.
No, okay, cool. Right. Yeah, let's have a quick look. Here's your sort of breakdown of the portfolio by theme. Those three themes, would you ever add another one?
We may add another one. We've got no need or desire to at the moment, just because of the sheer number of opportunities within those sectors. And as you know, these are particularly broad churches, so there's plenty of room for us to go into other verticals or kind of related areas within those particular sectors. And look, James, we're modestly sized. We're the main fund will make somewhere in the region of 3 to 4 deals a year. The Origin fund, something similar. We're not looking to deploy billions and billions in tens and tens of deals. So there's plenty of scope within these sectors.
And you talked about the sort of business founders reinvesting in the business. Do they come from all three of those sectors, or are they more concentrated?
They do, yeah, absolutely. Actually, as a rule, not by design, what tends to happen is the first time we enter into a particular field or niche, we tend to be led by a business founder, someone who's got a proven track record in that space, either has a business that he is growing to a certain size, he or she, and wants some additional support, a financial partner to help them with internationalization or M&A or digitalizing their business. and then with that success and the expertise we gain by working with them, then we will map that sector and then ourselves then go into similar businesses, maybe in a different geography or in a kind of a related area. So we tend to be led in initially by a founder in nearly all cases across all three sectors. To give you a sense, I mean, we listed the companies, but many of them won't mean an awful lot. Most of them are throughout Europe. But technology kind of started in communications for us, moved into from there we moved to web hosting. Web hosting took us into web hosting support software. That has then given us more expertise around business support software, and we're currently doing a roll up in SME business software in Iberia. If you're familiar with HG, it's like a baby Visma. And we're also doing a similar roll up in Germany of the software that supports online merchants. So that's the kind of direction of travel of technology. And in all those examples, we're typically being, kind of led in by a business founder who knows the space better than us. In consumer, the theme has really been dominated by kind of digital consumer and kind of online portals that I kind of touched on earlier, or companies that are offline, but there's an opportunity to give them a kind of a digital channel, to make them omni-channel, or to increase the number of kind of products they sell down their existing channels. And then finally, education started in premium schools, a roll up with a group called Inspired, and has now led us into most of the other education verticals: after school tutoring, tertiary kind of vocational education in France, higher online education in Germany, which is one of our stellar assets, our U Group.
And then these are the underlying companies. How many different funds are we talking about that you're invested in?
So Oakley Capital has now, it's got two fund families, kind of flagship fund, which is up to fund 4. And that's mid-market focused, looking to invest up to 150 million euros of equity in any one deal. And then there's a lower mid-market fund that was launched at the start of this year called the Origin Fund, which is basically enabling us to still invest smaller equity checks, but in exactly the same strategy. So that is on its first fund, and it deploys checks kind of 50 million euros and below. Okay,
so what prompted the launch of that?
It was prompted by virtue of the larger flagship fund getting to a size where we couldn't justify putting in smaller checks. If you're trying to deploy, maybe do 10 to 12 deals in the flagship fund, it's not economic for us to do half that size deal and 24 of them. So you've really got to focus on doing a certain size of deal in that fund, and that was meaning we were losing out. We suddenly couldn't participate in a range of opportunities that were being brought to us that actually were part of our success to date. If I look at the 40 odd deals that I've actually done to date, a good 15, 16 of those would have been lower mid-market, and we didn't want to move away from doing those deals, so essentially started a fund that enabled us to still capture those returns. And as you can imagine, smaller companies, I mean, these are still profitable established businesses, don't get me wrong, but at a slightly smaller size, you've got a richer collection of still family-owned, privately owned, founder-backed businesses. So there's also, kind of a big universe there as well, and potentially opportunities that may end up, kind of moving on to the flagship fund in time.
Okay, thanks. There's a slide here on how you did in COVID, and it probably is worth talking a bit about this. But also, I've got a question about how do you think the fund would perform in a sort of rising inflation interest rate environment as well?
Yeah, so we'll tick off COVID. I mean, actually, I think the two questions are kind of strangely linked by virtue of the way we were able to navigate COVID. But one of the stats I kind of mentioned earlier that circa 70% of 14 of the 21 of the portfolio companies deployed the products and services digitally. So no surprise that a similar percentage actually performed at or above pre-COVID budget levels. Those that didn't, is because maybe the sales cycle was lengthened. In the case of, for example, a Daisy or Group of Primavera, where companies during COVID were less likely to take, kind of bigger decisions about their software provision, take on major projects, plus your ability to get on site was impeded, and so your sales cycle lengthened. In the case of Schülerhilfe, this was after school tutoring. In Germany, if your child's not going to meet a certain grade for their exam, you're held back a year. It's pretty draconian. Clearly, if you don't have exams, well, then that threat is removed for a particular year. Plus, whilst we were able to switch to screen tutoring, digital tutoring, it's just not as effective, particularly for a student who's sat in front of a screen all day, as in-person tutoring to a child that probably needs that extra level of engagement. So there was a kind of a slowing of signups. Again, in the case of all those companies there that we've said there's modest impact, all of them have returned to the run rates that prior to kind of COVID. So we've seen the kind of the bounce back. And then the significant impact with those where there was a physical footprint in which they engaged with consumers, and that physical footprint was closed. Again, in all three cases, the physical footprint has reopened, and the early signs of trading are positive. You mentioned inflation. I guess there's two. Look, inflation is going to impact you, and a rising interest rate is going to impact whoever you are, and in whatever area of investment. I would suggest we're better insulated than most, I guess, because with the predominance of digital companies, you're talking about very asset-light businesses without the kind of expensive industry, supply chains that are going to be the big cause, or requirement for energy, which can be the big cause of inflation and with the biggest impact. So I think their cost of service, other than maybe salaries, but again, these aren't necessarily heavily staffed businesses, other than potential wage inflation, I think they, the majority of these be relatively unscathed. Of course, if you are providing a digital solution, in many cases, a direct-to-consumer or digital or a software solution is often the cheaper provision of a particular solution. So actually, you might find greater adoption of that solution in a high inflationary environment. To give you an example, I don't know, we own one of the leading fitness apps in Germany. Now, obviously, did well in COVID. People were less inclined to go to a gym, but clearly, the costs required to maintain and update an app that provides online gym classes and nutrition advice versus a gym with all the kind of hardware, kit and staff and energy and lights you got to keep on and rental, are all going to be significantly higher. And it's going to be even harder for that part of the market to compete with a solution like ours.
Okay, thank you. There isn't a chart here, but what's the sort of mix of vintages that you've got within the portfolio in terms of the maturity of the investments?
Well, there's two ways to kind of give you that. So, I mean, we're currently deploying the 2019 vintage fund. So we've got the first fund was a 2007 vintage, and there's only one investment left in that. The next fund's 2013. There's two investments left in that. And then sort of Fund 3 and Fund 4. Fund 3 fully invested, Fund 4 70% invested. To give you some sense of where they've been deployed. I guess, and maybe at the heart of your question, the average holding period of the portfolio is about 3.5 years, average across all 21 companies. The average holding period of all our exited companies is about 4 years.
Right.
So you've got, you would like to think over the next kind of year or two, you might see, if not refinancings, kind of reasonably attractive exits from a kind of a NAV growth perspective. And to give you some sense of the fact, kind of how we're doing, kind of currently, Fund 4, that most recent fund, 8 investments, average entry valuations 12 times, average EBITDA growth over the last kind of 12 months is mid 40s, maybe slightly higher than 40%. if you took out, there's a couple of crossover deals there where we've taken a minority stake in a company that we've sold from a prior fund, where we really wanted to continue to participate in the company, but we were coming to the end of life in a previous fund. So in those cases, there isn't any complaints. There's no risk we're navigating there. We know the company very well. There's perfect information. We've got a great management team. You know, EQT are investing in alongside us. And so if you take those two deals out, and which in this case are Idealista and WebPros, the average entry valuation for those businesses of the other 6 companies is 9.4 times. Exactly, strangely and coincidentally in line with our average entry valuation since inception.
I mean, there's a question here actually, it's just quite a good one actually. Why do you buy and sell things so much? Why don't you ever sort of hold things for forever?
Yeah, it's actually one of the structural problems of PE. The way the fund is set up is that you invest over a 5-year period and you harvest over a 5-year period. But in truth, you know, that those timelines are condensed. There is also a certain pressure to kind of, particularly in the early years of a manager in their first funds, to kind of show realized performance, because it's on that basis that people are willing to kind of invest in funds. So you do tend to find that holding periods are slightly shorter in the earlier funds of PE firms. Plus, potentially there is a bias towards IRRs, which incentivize you to make a return over a kind of shorter period. I don't think these are things that necessarily we're under pressure from, but I'm just kind of mentioning a number of the reasons why I think PE investments might be of a certain time horizon. But the main one being that structurally, you essentially have to sell them within a certain time period. The way in which we continue to keep exposed to these companies based upon all the intellectual capital we put into them is by crossover funds. Now, crossover deals used to be kind of frowned upon because of concerns around conflict of interest, etc., and how you get a third-party investment that everyone agrees to. Nowadays, and we'll typically invite in another PE firm who take a stake, and then we, if we're able to negotiate it, we'll then take a follow-on stake in a new fund. And we've done that 4 or 5 times to great success. And I think the industry is beginning to support that for exactly the point that the listener is making. That it makes sense to remain within these businesses that are performing so incredibly well. Now, there is such things as continuation funds now that do exactly that, much longer life funds that you essentially put your greatest hits into so that you can hold them for longer. Look, we don't happen to have one of those.
Okay. We talked a little bit about leverage. Does leverage vary a lot by company? How do you decide how much it is, and how that's changed over time?
Yeah, it does vary very much by company. Our average, so we don't have any leverage at the OCI level. There are fund facilities, and then there's the companies themselves have debts. The average net debt to EBITDA is about 3.5 times, which in PE world is low. I mean, I think the average within global PE is about 6-7 times net debt to EBITDA. I recognize 3.5 times, is higher than you might expect in the public markets, which tends to be around, they tend to try and limit themselves around 2.5 times. But if you are, as described, kind of very asset-light businesses, there's not much cost below the EBITDA. Much of that EBITDA converts to cash. It's growing at extraordinary rates, and so you can be very comfortable with kind of average net debt ratios of that kind. To your point, it absolutely depends on the company, the cash generation, the visibility of that cash depends on the kind of debt we'll take on by company.
Okay. I mean, we've got these 4 deals that you've done this year. How does that work for them?
In what sense? Sorry.
How have you sort of financed those?
Oh, how we finance it? I mean, in the majority of cases, they'll often be financed initially by equity. We tend to bring debt in at a later stage in the investment. I mean, Idealista, to explain Idealista, we had the kind of number 2 property portal, essentially the Zoopla of Italy, called Casa. We sold that to to EQT, who were doing a roll-up in the space called Idealista, and as a result, we were able to secure an option to invest alongside them, which we completed earlier this year. In that case, I mean, we are determining the capital structure. We've taken a minority equity stake. Dexter's, again, that was entirely an equity investment, same as e-commerce one. In time, and particularly as we establish these companies on, they become bigger, ICP is at the moment it's the third largest nursery school group in the UK. As we grow that business, and we, see it sustainable and growing earnings, then there'll be the opportunity for us to introduce, kind of more debt into that business. But typically, we don't put much in at acquisition.
Yeah. Okay, great, thank you. There's a few questions around discounts and things, but one of the things we ought to probably address. So you're trading at the moment on the specialist fund segment, that's right?
Yes. Yeah.
But are you planning to move to the main market?
We would ideally, and in fact, when we first moved to AIM, it was our intention to be premium listed, or at least main market listed. We didn't qualify at the time because of fund concentration. So it is our hope that, with opening more funds, that we'll be able to kind of navigate that particular restriction. If you've gone through the hassle of the prospectus and everything of going onto a fund, you're not going to immediately go through the same cost and time of then trying again quickly afterwards. But our general aspiration is to be, kind of premium listed within the next, kind of year or so.
Great. Okay, and I think that will help probably with the rating too.
Yeah, I agree.
Do you have a sense of where you think the fund should trade rather? Sorry.
In terms of compared to its NAV per share.
Yeah.
Yeah. I mean, I guess I've got two thoughts around this. I mean, if you've managed to demonstrate consistently that your NAV grows, then it's a bit like an operating company. You take a view on its future earnings, and that's the basis on which you value the business. The investment trust world seemingly is very backward looking, and it doesn't have perfect information because, of course, all the NAVs it gets are old. But it's clear that if you've got so many proof points, whether it's the premium, not just OCI gets, but most private equity firms get at exit. If nothing else for OCI, you've got all that weight of kind of large cap global PE money trying to be deployed, and you are there creating kind of asset investment opportunities for them. So we've got an incredible tailwind in terms of the potential future value of the portfolio. So I struggle to see why shares shouldn't trade at or above NAV, and my belief being that as you get to a certain scale, as you generate a track record through cycles, that's exactly what you'll achieve. Plus, I think the PE sector is relatively small. You don't have to own it as an institutional manager, and of course there are reputational issues from the past with PE, whether that's the global financial crisis and some of them being over-levered, over-committed, and you saw Candover run into trouble. Maybe it's past historic reputation of PE anywhere as kind of vulture funds. The quality of the managers and the conservatism which these genuinely the fund of funds and direct listed PE funds are managed now is night and day. I mean, I think this is an incredibly high quality sector, of which I would and do own stakes in a large number of them. Plus, I guess my other thought around this is that the shares perform based upon NAV growth. The best performing of us from a shareholder returns basis, we didn't outperform because we were a discount or a premium. HG, OCI, kind of a number of the other Harvest, the great shareholder returns. In fact, they were featured in the Questa column yesterday in the Telegraph. Their great performance was driven by their NAV. Discounts and premiums varied amongst the group, but they all were returning over the last couple of years shareholder returns in the region of 80-90%. That said, and I would absolutely encourage anyone to buy listed PE and particularly OCI on the strength of our future NAV performance, then there is an opportunity to close that discount. It is an attractive proposition if that discount, can close. And there are things we can do to do that. We've done a lot, but just because we've done them doesn't mean the perception has changed.
Mm-hmm.
There were things historically that happened around the issuance of shares at a discount. There wasn't an awful lot of alignment of interest between the manager and the trust. The buyback program was erratic. There was no dividends. The board, been there for 10, 11 years. Anyway, there's a lot of things we had to tackle along with, shareholder communication, and we tackled them. But just because you've done it doesn't mean that's immediately reflected in your valuation and your reputation. It takes time. The things we can do subsequent, going forward, one, we haven't touched on it, but historically, because post GFC, when the fund was raised, there was a lot of cash, and there was a lot of cash drag in the performance. And so to try to reduce that, the board made investments directly into the portfolio companies, either debt investments or equity investments. Look, it was a sound idea, but it has created confusion and fears around conflicts of interest, and ultimately the direct investments haven't performed as well as the funds. So frankly, I think when we've removed the residual direct investments, we've got one debt investment and one equity investment, remove those, I think that will be helpful in making a simpler story, removing that conflict. I think the listing, I think, as you mentioned, I think will be helpful. Plus, we only report our NAV on a half-yearly basis. And I think moving to quarterly will be very helpful, and revaluing the entire portfolio every quarter, which maybe isn't the norm within the sector, I think again will be helpful. Just providing more proof points, more news flow, better communication to the market, I think will be helpful. The first quarter we'll do that is going to be Q1 of next year. And look, we're lesser known. We haven't got the profile maybe of some of our bigger peers like an Apax or an HG, but that will change with our size and scale. And we're already being recognised for our comms. We won the AIG's best report and accounts for the alternative class for our 2020 report and accounts, all of which I think show our intention to kind of be blue chip and best in class. Couple that with our ongoing performance, and I'm sure and hope that the discount will close.
Cool. And presumably you wouldn't issue shares at a discount again?
No. And we've made numerous public statements to that effect.
Yeah, exactly. Good. All right. And perennial fees question. I know Shane to finish on this, but I think it's important that we do tackle it. So can you explain a bit? Obviously, we all hate kids, but explain how the fees work, please, and the sort of look through and stuff.
Yeah, as much as it pains me to have the kid fees used in this case for all kinds of reasons, because it takes averages over 3 years. There's no consistency across how we all report them, and it's only seemingly applied to kind of closed-ended. So there's everything that's some things that are wrong with them. However, they do exist, and so we figure it's better to provide as much explanation about them as possible. To kind of put them in the two buckets, the ongoing costs versus the incidental. So ongoing costs is essentially, and to be clear, OCI pays fees to the manager by listing in the funds as the same fees as every other investor in the private equity funds. So it pays a 2% management fee and a 20% performance fee, the same as every other investor in the funds. And then the only other fees it pays is basically the kind of running costs to be OCI. It doesn't have, other than its board, it has no staff, it has no offices, but so therefore, it needs to have recharged to it in the cost of its fund finance and accounting teams, legal teams, communication, IR, etc. is all charged back. So on the ongoing costs, you've got the management fees there of 2.13%. They do feature some historical charge that used to be charged to the direct investments, which are still in the number because it's a 3-year average. And so consequently that you should see that number come down. OCI expenses are all those recharges that I've described. So that's your kind of key ongoing cost. The performance fees, so they're broken into two types. One is that performance fee in that first column in that second half. Now they are the performance fees that were historically paid on direct investments, and again they're no longer charged. So that will be traveling down to zero as they drop off the average numbers. And then the carried interest is exactly that performance fee that's described. That is the, kind of the 20% that's charged above an 8% hurdle. And in theory, that's the largest chunk of fees. And it's exactly the fee you hope to be paying because it's driven by performance. So the largest, kind of fee, the largest fee payers are ourselves in HG, entirely driven by the performance fee or the carried interest in this particular case, because we're the highest performing funds.
Do you think that performance fees are important for you retaining staff?
Absolutely, yeah, completely. I mean, the management fees, they're just starting with the management fee. Most of that is spent on the sheer size of the teams you need. I mean, in some investments, we're working on those investments for many years before we make them, and then when we make them, we're not just making investment. We're on the board. We're heavily engaged with those companies throughout the life of those businesses. Huge amount of due diligence and work goes into working alongside them, and analysis and fees that are committed as a result of that. So most of the management fee, so much of that is consumed in big, kind of talented investment teams. A public market fund manager could deploy a couple of million with a senior fund manager and possibly a couple of analysts. Here we're deploying that kind of money with a team of 35, 40 investment professionals. On the carried interest, absolutely. I mean, being linked into the performance of having your main incentive driven by your performance, not by your salary, is absolutely key to attracting the right kind of professionals into this industry.
Cool. Thanks very much for that, Stephen. I think we'll finish up on that, if that's all right with everybody. I know there's a couple more questions I always ask, but we'll come back to those another time. So that was, I think, really interesting and nice sort of trip around the world of private equity. And we'll follow your progress with interest. And
well, thank you once again for inviting me on, and as always, very good to speak to you, James.
Cool. Thank you, Stephen. We'll be back next week talking to the manager of the new Aberdeen China Fund, which is being formed from the merger of Aberdeen New Thai and Aberdeen Emerging Markets. So it should be quite interesting to see what they're going to do there. And obviously, what's going on in China is going to be a big theme, I think, as well. Then we've got a Scottish Mortgage the week after, and a lineup we've talked about before. The new one on the end there is Helen Steers, so from Pantheon. We've already mentioned before last week, I think, our ESG webinars, which are coming up, and we're starting to populate those. So there's look out for announcements about who's going to be speaking, but I think we should have quite an interesting lineup, I think. And as I mentioned, also look out, I think we'll be emailing out so shortly, but we've got a presentation, I think, going on for Downing on Monday. So please look out for that too. So that's all from me this week, and have a good weekend, and we'll see you next Friday. Thanks, bye-bye.